Welcome to our Options Education series. In this segment, we'll learn about diagonal spreads, a versatile tool for traders who attempt to generate potential income from time decay and market moves while managing risk. The name diagonal comes from how the trade is set up, which combines two types of spreads: a horizontal spread, which uses different expiration dates, and a vertical spread, which uses different strike prices. You can think of a diagonal spread as a hybrid of these two strategies. Here's how it works in simple terms. A trader buys a long-term option and pays a premium, then sells an option that expires sooner. Both options are the same type, either calls or puts. This strategy involves using different expiration dates and strike prices. In short, you pick a long-term option that is different from the short-term one, making it diagonal. Diagonals can be used to potentially benefit from time decay and changes in volatility and price. The potential profit from the underlying price movement depends on the type of diagonal used. There are two main types: call diagonals and put diagonals. A call diagonal consists of two call options, buying a longer-term call option and selling a shorter-term call option. The premium collected from the short call lowers the position's cost basis, while assignment risk remains until the short call is closed or expires. The long call can help limit the risk. Let's view an example to see how the bear call diagonal works. Using the TradeStation workspace, the radar screen filter showed ConocoPhillips COP as a bearish candidate. The weekly chart shows prices moving within a channel between $104 and $114. On the daily chart, we can see more details of the price action and draw the channel between $102 and $114. If we expect COP to stay within the channel or become more bearish, we can open the diagonal spread by first selling the November 15th 105 calls. This short call has less than 30 days to expiration and should experience increased time decay and benefits from a drop in the price of COP. Next, we will buy the January 17th 115 calls. The more extended time frame option will have lower exposure to time decay, and the long call helps limit the risk from the short one. The cost of the diagonal spread depends on two main factors: the distance between the strike prices and the time until the options expire. You'll get less money up front if the strike prices are close together because the option you will buy costs more. Additionally, the more time until the options expire, the higher the options cost. This affects whether you pay or get money when opening the position. The risk profile shows that the position was open for a credit of $1.38. Call diagonal spreads are usually open for a credit. However, debit call diagonals are possible. The maximum risk and reward will vary depending on whether both options are closed at the expiration of the first month. For example, if the November 105 call expires in the money and the long call is sold simultaneously, the loss would be the spread width of 10 minus $1.38, resulting in a loss of $8.62. The objective of the diagonal is to have the short option expire worthless, allowing the trader to collect another premium by selling a new short-term call against the existing long position. In our example, if COP trades at 103 when the November 105 call expires, the premium collected from selling the option becomes realized profit. We would still hold the 115 call and could sell the December 105 call to collect more premium. We could sell a lower or higher strike depending on the premium and our expectations of future price movement. The call diagonal is sometimes called the poor man's covered call. It can be used similarly, substituting a long call for long stock at a reduced cost. Once the December call expires, the January call could be sold to recoup time value and possible intrinsic value, or held to expiration if COP's price rises above 115. The put diagonal consists of two put options, which attempt to profit from a neutral to slightly bullish underlying security. It's a blend of a bull put credit spread and a put calendar spread. In our next example, we chose Borg Warner as our bullish security from the radar screen. The price has been moving sideways, but it may be ready to bounce from the top of a previous range. With possible support at $34, we choose to sell the November 15, 35 strike puts with only 28 days to expiration, which will help maximize time decay. To limit the risk, should the put expire in the money or be assigned, we will buy the January 17, 30 put. We now have a bull put diagonal spread open for a 90-cent credit. While credits are the most common type, put diagonals can also be open for a debit. The risk profile looks like the call diagonals flipped horizontally. The optimal outcome for the trade would be for the short November option to expire out of the money, and the premium would become realized profit. The trader could then sell another put with a December expiration to collect an additional premium. If BWA's price dropped and the November 35 put expired in the money, the maximum risk would be $4.10. That's the difference in strikes minus the premium collected. Diagonal spreads are versatile and can be adjusted during the trade if conditions allow for more credit. For a call diagonal, if the underlying price drops, the short option may be bought to close and a new call with a lower strike price may be sold to collect a more significant premium. Conversely, if the underlying price rises rapidly, the short put in the diagonal may be bought to close and a new higher strike put can be sold to collect a larger premium. Traders use diagonals for several reasons: to profit from time decay, to benefit from a specific price move, to reduce the cost of buying long-term options, and to create a position with defined risk. Before attempting to trade diagonal spreads, you must fully understand their risks. Some of the potential dangers of diagonal spreads include they are a complex strategy that requires careful and active management. There is a risk of loss if the underlying moves too far in either direction. There is a potential for early assignment on the short option, and they may require more capital than simpler strategies. Practice placing and managing diagonal spreads using TradeStation while logged into the simulated mode. This will allow you to experiment with the strategy and order placement with real-time market data and instant feedback without risking real money. Once you gain confidence and skills, the transition to trading diagonals in a live account may be smoother. Always consider your risk tolerance and market outlook before using this strategy. Diagonal spreads can be powerful tools for options traders, offering a mix of income potential and directional exposure. However, they require careful planning and management. With patience, analysis, and practice, you can add this flexible strategy to your options trading arsenal.